how close are we to getting a second oil crisis, the likes of which has not been seen for almost 50 years? And what's next?
Well, uh, let's go back just a little bit before that to put me in context. The first faculty position I actually had was at the Colorado School of Mines, uh, world's top mining school, obviously. So it was a great place. And I taught the first course that was ever taught there in petroleum economics in the late 60s. In 1968, actually, one of the, I guess, the second book on petroleum that I edited was produced in 68. That's quite a while ago, David. And it's called, for your reference, Political Economy of Energy and National Security. So the topic was exactly the one that we're talking about now. That was about 60 years, almost 60 years ago. So at any rate, moving forward, then in 1985, late 1985, December of 1985, I had developed a plain vanilla model of OPEC, the oil cartel, and it looked to me like it was going to collapse. And I predicted that oil would drop down below $10 a barrel, which it did after OPEC collapsed in 1986. And looking back at the time, I was at Friedberg Mercantile Group up in Toronto, and we had very big short positions based on my analysis. We ended up with over 70% of all the short interest in the London market and the gas oil contract. So let's go to 78, 79. Or should we go to 73? We had an OPEC embargo then. And gas prices did go up. We had gas lines. It was all very much aggravated because we had price controls. So that posed a problem, at least in the United States. Now, if we go to 78, 79, let's look at the situation now versus then. And I think the potential for disruption is lower today than it was then, David. And the reason for that is that Iran in 1978 was producing 8.5% of all the world's oil production. Now they were producing at 5.2%. So that's less of a disruptive factor. The Mideast, 1978, they were producing 34.3% of the world's oil. Now 31. So they're less of a factor than they were. And the U.S. was producing 15.6% of the world's oil in 78, and now we're up to 18.9. So we're less dependent on foreign production than we were then. Another big factor that makes things better now than they were then in 1978, 79 is that the oil intensity, the amount of oil that we use per unit of GDP is declined dramatically from 1.5% down to 0.4%. So that's in the picture. Now, there's a lot of narrative being spun in the newspapers and article after article, which is all wrong, and that is that the oil price increase is, which we've had, by the way, the oil price in the last week is up, a little over $17 a barrel for WTI, West Texas Intermediate. So the price has gone way up. Gasoline prices have gone up. And there's a lot of chatter about, well, this is going to be very inflationary. No, it isn't inflationary. It simply means that the price of oil and gas and items produced from crude are going up in price relative to everything else, but it doesn't mean we'll have inflation. And the best example to make this point is that look at Japan. Japan, of course, imports all of its oil. It doesn't produce oil. And in 1973, the price of oil shot up with the embargo, and the Bank of Japan accommodated that price increase by increasing the money supply, and not only the price of oil went up relative to everything else, but Japan got more inflation. Then in '79, of course, we had another oil crisis, and what happened? The Bank of Japan said, no, we're not going to increase the money supply to accommodate this. So you had the price of oil going up in Japan, but it wasn't accompanied by inflation because the Bank of Japan never goosed the money supply. So inflation is always and everywhere a monetary phenomenon. You have to look at what's going on with the money supply. And that is a causal factor behind inflation. It doesn't mean that we won't have oil and gas prices going up relative to everything else. That's happening as we speak today. So there you have my take on the thing. The potential disruption is, on the face of it, in the United States less than it was in 1979 for the reasons that I gave you. Now there is one factor actually that makes things worse and more vulnerable, and that is that the stock market is in a bubble. It's in bubble territory, and it wasn't in bubble territory in 1978. The PE ratio was 8. Now it's up in 29, 28. So when you're in a bubble, obviously the bubble's always vulnerable to an external shock. But surprisingly, we haven't had, the market's taken a hit, the equity market, but I think surprisingly the hit's been pretty small given the vulnerability of the market due to the fact of very high and elevated valuations.
If you liked this clip, then like the video and share it with your friends. And if you want to watch the entire full-length long-form video, then check out the link in the description down below.